Then I would suggest we move forward to the fourth paper of today, which will be presented by Nicholas Cumming from Florida Atlantic University.
Okay, thank you very much for the opportunity to join you. I realize I stand between you and dinner, so hopefully I won't keep you past the deadline. I am very fortunate to work with Lars Haas from Strathclyde, Linda Myers, an accounting professor at the University of Tennessee, and Monica Tarsaluska. I'm terrible at pronouncing her name as Canadian pronunciations. She's at the University of Exeter. They're great colleagues to work with. And we had the idea that it would be fun to look at disclosure of material weaknesses in control. It's a feature of the Sarbanes-Oxley Act, so a requirement put in after Sarbanes-Oxley. And there seems to be significant concern about this amongst venture capital practitioners. And so, for instance, the National Venture Capital Association, in some of the documents that they put out, highly recommend following these standards. They think it's quite an important feature to be concerned about in promoting good governance standards. Now, you might wonder, well, we know venture capitalists on average tend to do good things, improve the governance standards of publicly traded companies, so aren't the results going to be obvious? But when you look at recent research from, for instance, Sheen et al., among others, it shows that venture capital or private equity backings might do some harm. So, for example, Jeff Wood has put out recent work that shows that venture capitalists have caused, and private equity funds, after they get engaged in financing, they cause a reduction in jobs. We find in some recent work that we've done that private equity-backed buyouts end up causing a destruction in innovation. Here's a paper I cite on this page, one that I saw recently, Sheen et al. They look at the financial advisory industry and the role of private equity, and they show that they have a drastic increase in misconduct. So 147% increase in misconduct cases associated with private equity. So there tends to be quite a mixed literature on the good value that and governance that venture capitalists and private equity funds provide. So the question isn't really one with a necessarily obvious answer. And it's one that I've also encountered with in doing a bit of expert witness litigation work, where we see it tends to be quite an important element as to the share price reactions of these transactions and early disclosure of material weakness problems. So it does seem to be a significant factor that we shouldn't ignore, and we can learn it from in so far as looking at the role of venture capital in this issue more generally. Our prior is to think that venture capitalists do good things. Certainly, the vast majority of the literature is consistent with that viewpoint. It's only those recent papers that I summarized on the last page would be inconsistent with that point of view. But if you look back to the very early days in the mid-1990s or even earlier in the entrepreneurship literature, we know that venture capitalists do tend to provide good governance. They have an important impact on the firm's development. Paul Gomper has really formalized this in terms of the monitoring that staged financing provides. And so in order to get an additional financing round, you have to show that your firm is properly governed. The contractual features in venture capital and private equity are contingent on showing verifiable information, despite that we all know in this law and finance sense that we're dealing with an incomplete contracts world, that venture capital contracts do seem to matter. In some of the work that I've done with my better half, Sophia Johan, and I, in a European context and in the European Economic Review and another project we did in RFS, look at how this contractual information can influence firm outcomes, particularly when you can show it's reliable information. So on average, we think that VCs are going to establish better internal controls to manage their portfolio, which is going to lead to good outcomes in respect of their use of this material weakness and control disclosure requirement under SOX. So it becomes an empirical exercise to see if this is actually true and to see what's going on in the marketplace. And so what we decided to do is start with IPOs in 2001. The reason we started this is that the SOX requirement started in 2002, and we're going to look at processes that go over a 3-year period post-IPO. So we have data where the IPO starts up until 2018, and then we examine the subsequent 3 years. So this most recent iteration of the paper, we have data, it's almost up to today, but as close as reasonably possible. We do the usual things of eliminating suspects that we don't like financial institutions, REITs, closed-end funds, spin-off, former LBOs, foreign firms. This is U.S. data. And the normal thing is we engage in some mergers of data sets. So in this case, we merge SEC Platinum with audit analytics in order to get information on material weaknesses in internal control. We also use information from CompuStat on financial information of the firm. We gather some additional characteristics of VCs in Venture Expert. And in total, as we know that it hasn't been the great last 2 decades for IPOs in the US, partly due to SOX and Sarbanes-Oxley, and amongst other economic explanations, is that there hasn't been a tremendous number of IPOs in the US, certainly more around the world. But nevertheless, in total, our sample comprises 694 IPOs, 69% are VC-backed, and 31% are not VC-backed. You want to know more about these disclosure of material weaknesses and controls. So this is an SEC requirement, specifically Section 302 of SOX requires top management to establish and maintain these internal controls, make sure that this information is known. They have to evaluate the effectiveness of these controls and disclose on a very timely basis deficiencies in the design or operation of these internal controls. And that's where things have had less attention in the literature that we focus on. You might wonder, well, what exactly is an internal control? And so we have some help with this. It's a process affected by an entity's board of directors, management, or other personnel designed to provide reasonable assurance regarding the achievement of objectives related to operations, reporting, and compliance. And so in general, we might think that problems associated with internal control would be related to typically accounting problems or other company problems. And in the practice, as well as in the empirics, there are 2 main types of internal controls that people focus on. And one is the accounting level internal controls. And so an example of this comes from 2007. Fairpoint Communications is an account level internal control. And it's basically discussing the fact that errors existed in capitalized software costs, operating expenses, accounts receivable, prepaid expenses, and accounts payable, accrued expenses in our preliminary 2007 consolidated financial statements. This is what the release of that information pertains to. And importantly, and I'll talk about this more later, is that this significantly predates accounting misstatements. So one way to think about this is that it's an early warning, It doesn't necessarily lead to an accounting restatement, but it could lead to an accounting restatement. Another one is at the entity level. So I said 2 types of internal controls. One is an accounting level, and the second is a more serious one about an entity level material weakness. We give an example here from 2006, Alpha Tech Holdings, and essentially they talk about the fact that they don't even have staff that can do properly financial accounting and reporting functions. And so it's not merely an absence of the quality of the financial statement reporting, but instead, in this case, the lack of people that would do that reporting. So perhaps a more serious breach. In our empirical exercise, we estimate a typical model. So we want to know if the company is VC backed. We have a set of control variables that are derived mostly from Compustat about the financial quality of the company, amongst other things. And then we use many vectors of fixed effects. So we have industry, time, and region fixed effects. Typically in this, in our set of regressions, we just use state level fixed effects. You could say that there are biases with what VCs pick. So maybe VCs just select companies with better internal control. And to account for this issue, we do the usual two things. One is we run an IV method to see if we can predict whether or not a company received venture capital backing based on some variable that's going to be unrelated to our outcome associated with internal control. And in particular, our variable, which we believe satisfies the exclusion restriction, and one has been used in other empirical papers, is to use a state level aggregate amount of venture capital at the time the company was seeking venture capital. And so that's one instrument that we use. And then the second is we create a propensity score matched sample. And under both cases, I'll show you that with the results we find are quite robust. Now, you might wonder, well, what might lead to other material weaknesses apart from venture capital? It could be something about firm size, so we control for market capitalization, complexity, the extent to which they deal with foreign transactions, the financial health, whether or not they have losses, or their bankruptcy prediction score from Altman's models, the Z-score, their development phase, a growth phase or restructuring phase, if they have a big four auditor, so maybe to do something with detection. And then with the IPO characteristics, we look at underwriter reputation, IPO underpricing. I see my slide needs to be a little bit fixed, just notice that. And then if they've had a secondary offering. And how do we measure this? This is a overly complicated slide. I can really explain it quickly, is that we're looking at and counting things based on quarters. So we focus on our regressions on either 8 quarters, which is 2 years, or 12 quarters, which is 3 years. And then after an IPO date, which might come anytime within a particular quarter, we then examine the next 8 to 12 quarters to see if there's a material weakness in disclosure report. And we give a simple example here of this Digigrad Corporation IPO, and then we follow the next 12 quarters. It's just to give you a bit of a better sense as to our data and measurement. And of course, as we often like to do, before showing a regression, as we know in stats, there are lies, damn lies, and then statistics. So it's nice to just cut the data with the simple means and comparison tests. So we present that, and I can show you very briefly what the data look like in our sample. So we see over a 2-year period that venture capital backed IPOs tend to be ones that have fewer material weaknesses in disclosure over a 2-year period. Those differences are statistically significant, highlighted in red, but over a 3-year period, there are also fewer, but they are not statistically significant. And that's true if you look at all the material weaknesses in disclosure, or if you focus just on the accounting level material weaknesses in disclosure, or just on the entity level material weaknesses in disclosure. Sorry. Some additional things about underpricing. Our underwriter reputation, the VC-backed ones tend to have more reputable underwriters. In our sample, the underpricing's higher, and you may have seen over the years that VC-backed IPOs are underpriced or more or less underpriced depending on the particular sample period. And so in our sample period, they're more underpriced. They tend to be a little larger with higher market capitalization. They more often engaged in foreign transactions. They more often have had losses in the past. The bankruptcy risk is higher, and they're more likely to use reputable auditors. Graphs are always kind of nice. Here, the frequency of internal weaknesses, or the average number per quarter going over 3 years, so 12 quarters. And this is for all types of material weakness. The little dots are the venture capital backed ones, and the big dots are the non-venture capital backed ones. The solid line is the average in the sample. So you see that the venture backed ones have fewer disclosures, and that's for all types of material weaknesses. Here is just the accounting ones. The accounting ones show consistent evidence, and you see that in the last year, again, the differences get narrower, so the role of venture capital dissipates in the third year post-IPO. And then the other thing to notice, this is for entity level material weaknesses, is that the frequency goes down as well, but nowhere near as pronounced a drop as in the accounting level. And then the other thing perhaps to notice is that the number of material weaknesses is a little bit higher for this. So this is accounting level. The numbers here on any given quarter, about 0.1 to 0.15, and then here for the entity level, the more serious ones tend to be at a slightly higher level in any given quarter. Okay, so material weaknesses happen, but it's not a regular occurrence. So there are different empirical ways of dealing with this. We decided on Poisson regressions to account for this high frequency of low number of events. So that's, and the low frequency of high number of events. It's not the only way to deal with this. And of course, we've run 10 million regressions and picked our best ones. I'm kidding, of course, but indeed this is something that is robust to a number of different specifications. And I don't want to focus on all the variables, but just to highlight the most important one at the top is the venture-backed. And it does indeed tell us that the venture-backed are less likely to have material weaknesses in disclosure, or material weaknesses in internal control problems. And then conversely, the ones that are more underpriced are much more likely to have material weakness problems, ones with similarly higher market to book values. And then the auditors, the more reputable auditors, significantly less likely to have these internal control problems. And then in terms of the economic significance, if it's venture-backed, then it's up to 2 fewer material weaknesses compared to non-venture-backed companies. And so that's not only statistically significant, it's also economically large. The endogeneity results that I talked about earlier, so we run a first step model. We're looking at state level funding in venture in the year which those companies were looking, and we see that that's positive, statistically significant. And looking then at the predicted values, it's all the results come out very similar across each of the different models, and we find that's negative effect having venture capital backing. Similarly, if you run propensity scores, match samples, where we match here on underwriter reputation, underpricing, market book, secondary offerings, market cap, ROA, if the foreign transactions, loss, bankruptcy score, growth, restructuring, auditor, as well as industry and near fixed effects, you find, again, very similar results. More on this table, you, instead of having dummy variables for measuring the role of venture capital, you can look at the percentage ownership. And there we too see that the results are significant, and with not just statistically, but also economically. And so 1% increase in VC shareholdings reduces the probability of material weakness disclosure by roughly 1.79%. And then for 2 years after the IPO, and 1.43% for 3 years after the IPO. And those are the results in that regression. And I just want to tell you about one more fun issue. And this is having to do with a company that I'm aware of that faced a lawsuit. And it brings in the issue into focus as to, why do we care about this type of thing? And it's partly a Canadian company, but it also trades in the US. And as you may know, that Canadians have a very progressive leader that made marijuana legal. So he might not be the coldest beer in the fridge, but he's very popular because he has nice hair and he's good looking, apparently, according to all the ladies in Canada. And so he made marijuana legal. So marijuana companies have done very well. They tend to be often subject to lawsuits. So the people running marijuana companies are exactly as you would expect them to be. And so this is no example. So this marijuana company is a memorable one. They, marijuana, if you just leave it sitting around, the product gets moldy, and so you have to send it out for cleaning. And so what this company did is they decided, well, wouldn't it be good to count that as revenues when we bring it back into the company? And so the revenues were overstated by $500 million. And of course, when they announced that, oops, we overstated our revenues, they of course, as required by SOX, because this company trades on NASDAQ, as required by SOX, they had to disclose that there was a material weakness. And almost at the exact same time, they made an accounting restatement. And that's the type of thing that's not terribly interesting for us, because we see these material restatements that, or the material weakness and disclosure needs to be an early warning signal. So what we wanted to do is look at, are these early warning signals something that's effective and material for predicting an actual restatement later on? So not like the Kronos case where they did it roughly contemporaneous. Technically, there's a couple of days in between in this particular case in March of 2020. And so we wanted to see if this is an effective early warning signal, and indeed, if venture-backed is a more effective early warning signal than non-venture backed. That's our last piece of evidence in this paper. And so just some nice statistics here is that 19 of the non-venture backed companies, 19%, compared with 15% of the VC-backed companies, make restatements or within 2 or 3 years after the IPO. So these restatements do happen in a way that's important. And so, of course, we're going to run this in a regression framework. And just to quickly summarize, as I know I'm taking up too much time, in our regression framework, we interact VC backing with a material weakness and disclosure to see if that can predict in a subsequent quarter a restatement, a financial restatement. And we see that it does, in a significant way, make that type of prediction, and it's statistically significant at the 5% level. So indeed, it does serve as an early warning, and that's only for the venture capital backed. The non-venture capital backed, there's no predictive ability for them to see if they have a subsequent restatement. Okay, so to quickly wrap up, therefore, what have we shown in this paper? We've given you some anecdotal evidence that you might think that material weaknesses in control are important. They're helping us better understand the quality of information released from publicly traded companies, and they can serve as an early warning signal. Is there a role for venture capital-backed companies to help improve the quality of this information? And the data that we examine seem to be consistent with the idea that yes, that venture-backed are more informative about this information that's released from publicly traded companies, but not for not the non-venture capital backed companies. If you have questions, comments, we very much oblige. The paper is not yet published. And as with any other paper that I published, that's greatly benefited from my co-authors as well as comments from forums like this. So thank you once again for the chance to join you from Italy. Thank you. Cheers.
Thank you. Very interesting results. Yeah, I'll hand right over to the first discussant, Kobi Kastiel.
Okay, can you hear me?
Yes, very well.
Okay, so hello everyone. Hang on a second, I'm going to share my slides. Can you see the slides now? Okay, perfect. So hello everyone. I'm delighted to be here. It's been a fantastic first day of the conference. I truly enjoyed. I enjoy also the mix of practitioners and economists and legal scholars, and you know, to see how the different topics relate to each other. So it's been really great, and thank you to the organizers for inviting me. Thank you also, Douglas, for sharing your super interesting work and for the opportunity to engage with it and to comment on it. I like the paper very much, and I learned a lot from it. So just, you know, Douglas discussed the paper a lot, so I just summarize it quickly in one slide and move forward to my comments. So generally speaking, the author finds that VC-backed companies have stronger disclosure controls and procedures, as evidenced by the reporting fewer material weaknesses in their internal control under Section 302 of the Sarbanes-Oxley. These disclosures, it's important to note, are also more informative, and they are more likely to be followed by subsequent financial statement restatements than our disclosure made by non-VC-backed IPO firms. So the conclusion, VC firms play an important role in determining the quality of companies' internal control, which is in line, as Douglas mentioned, with early work on, or prior work on VCs that shows their important monitoring role. Now, Douglas, here I have a minor comment just by listening. I just added it as you were discussing, you were making the intro to the paper. You cite recent paper on PE and the risk they pose to other stakeholders, land of employees, etc. It might, you know, the story about VC might be different than the story about PE. So I don't know if you want to tie them together or not. It's a question. But you know, it might be slightly different. I agree with the way you cite the evidence of PE, but just the question as to what we can learn from it about VC. It's a slightly separate question, I think. Overall, it's an extremely interesting project. It's a highly recommended reading if you haven't had a chance to do it yet. A new data set, very sophisticated empirical analysis. You have just seen it. I would just say, before turning to my comments, because I'm coming from a legal background, so it won't be, you know, I won't get into all the details and the regressions, but should be more high-level comments on the story behind it, and basically I will come up with two major suggestions. One suggestion, maybe try to explore a little bit more what's going on there, and to see whether there are any different characteristics of firms that are backed by VCs. What are the channels of influence? Whether we can tell a richer or a more nuanced story about what's going on there. So those will be one line of comments. And the second line of comments will be related to alternative stories. And Douglas, you discussed this already with the question of endogeneity, and I'll try to emphasize a few more points on that end. So when we think about, I think one important issue is to understand the channel of influence, right? And how exactly VC improve the reporting standards and support the finding that we find in the article. So I think it could be interesting to see, and it relates to the discussion we had with Eric Talley earlier today, whether this VC appoint their own directors in all of the situations. If not in all of the situations, do we see any differences in the quality when the VC has a board representative or not? And what exactly those board representatives are doing that might help understand that. Do VC-backed firms have better governance terms in general? I mean, do we see a connection here? Especially, do they have more independent boards, committees, frequency of board meetings, better lawyers to see what's going on there? Do they stay longer as private companies on average, and therefore they are more mature when they tap the public markets and they have more time to improve the reporting system? It's not a transition from someone who is managing a private company to, it's like a gradual transition in that regard. So they have more time to prepare to that. What are the characteristics? I mean, I think it's interesting also to examine what are the characteristics of firms that are not backed by VCs. Those are family firms, foreign firms, backed by PEs. We see any systematic differences. This may also explain differences in the report. And also, it might be interesting to see whether VC-backed companies cancel their IPOs more often. Ala Bernstein, a study from 2015, maybe in that regard, they eliminated companies with more problematic disclosures because they don't tap the market at the end of the day. So to also see what's going on with those that cancel their IPO eventually. So those are the type of issues that can shed more light about the channels of influence and how exactly VC prove this type of monitoring system. The other type of comments is about the alternative story. Now, I must say up front that I'm very persuaded by the author's main thesis that VC plays an important role in enhancing the quality of IPO disclosures. I think they show it very nicely in the paper with a lot of evidence, but still we can raise at least two alternative stories. Financial economists might raise many more alternative stories, but I'll focus on two stories. Right, one story is the selection story that Douglas referred to it as well, is that VCs are just good pickers. They ex-ante select companies that have better disclosure practices and not necessarily improve them along the life. So that's one explanation. Then it will suggest that they don't necessarily add value in that regard. And the other story might be an agency conflict story, right? We can think about an explanation that VCs actually have incentives that material weaknesses won't be disclosed after the IPOs. Why? Because after the IPOs, in this 2-3 year period, they need to liquidate their position, and they don't want to be in a situation where they have to sell their position in discount because a restatement is there. So maybe they just cooperate with management on that regard. So that's the agency conflict story. So I'll start with it. I think that an interesting way to examine it, and Douglas, I don't know if you have checked it, or at least I haven't noticed it in the paper, is to see what happens after the 3-year period. So what happened in the longer term after the VC actually liquidate their position. If we don't see there a normal number of disclosures that related to statements, etc. If it's a turn off on the top issue, right? If the VCs have a more profound impact, then we might see also that these patterns continue in the long term. So I think that's if you want to see whether they really made a long-lasting impact on company disclosures, we might want to look about that as well. One concern generally about this type of disclosures, that it might be endogenous in the sense that managers decides whether to reveal this information or not. So again, it shows that there could be some room for manipulation here. It depends on type of enforcement later on, but it can be done. The other story is the story of endogeneity. And as Douglas mentioned, the author controls for endogeneity in various ways. One of them is by using an instrumental variable, looking at the supply of venture capital when entrepreneurial companies are founded. And this instrument, the argument goes, are likely to be related to governance structures year later at the time of the IPO. But here I raise a question, which is related to a topic that interests me personally, which is, wouldn't the supply of these funds will affect the bargaining power of the founder? Right? If there is a large supply, that actually increases the bargaining power of the founder. And I think the entire, I mean, the ability of the VC to provide monitoring is really related also on the bargaining powers of the party, the founders versus the VC. It could impact also the quality of disclosure. So maybe there is something that can be examined here as well, right? To look at situations where the founder has more bargaining power versus less, and more bargaining power can be dependent on the status of the founder, the time to IPO, industry. I mean, in some industry, there is no need for cash infusions, market conditions. So maybe you want to explore that and see whether it causes changes in the quality of the practices. There is an interesting paper by Ofer Eldar that look at dual class and show that there is a recent rise, Ofer Eldar co-authors, and they show that there is an increase in the use of dual class shares in the past 2-3 years, because basically founders have more bargaining power in this type of environment. So to see how it impacts the quality of disclosure practices, I think it could also be interesting. We also know from certain situations that when it comes to superstar CEOs, VC monitoring abilities are more limited. Right? I have a recent paper with Asaf Hamdani exactly about superstar CEO and the challenge they pose to corporate governance. Elizabeth Polman also has written about it. So in this type of situations, think about high-profile scandals. We actually have VC without that effective monitoring, those examples of superstar CEO and scandals that we're aware of. So it could be interesting to see where the enhanced monitoring works well and where it could be problematic. And I mentioned the example of dual class IPOs because I think it also poses a puzzle in the literature. I mean, the VCs have no incentive to go along with dual class shares or something because they, it may reduce they may get a discount when they try to liquidate their position. But if the founder is very charismatic, and if the founders wants the dual class, they will go along with it. So there are some situations when the monitoring power of the VC is limited, and I think it will be interesting to see how it can come to play in those situations. There is also a question of the differences in the quality of the VCs. You mentioned in the paper that you don't find improved internal quality control when VC backing is from VC firms with higher reputation. I think it will be interesting here to develop it a little bit more and try to control for other factors that could imply quality of VCs or the reputations. In terms of the economic significance, it was discussed in the presentation as well, but I think it would be helpful for the reader to understand a little bit better, to get a better sense of the actual impact. I mean, you explain that, or you find in the paper that companies backed by VC firms, they close on average up to one fewer account level material weaknesses and up to one fewer entity level material weaknesses out of how many, and in general, and what's the impact on or what could be the impact on fair value of this type of problematic disclosures. So if you can emphasize it a little bit more in the paper, I think it could be helpful. So just to conclude, it's an extremely interesting project. It provides important evidence on the governance role of VCs. And in my brief comment, I just suggested a couple of follow-up tests to rebut alternative hypotheses and enhance the finding. Thank you very much.
Thank you. Wonderful. Okay, so we have the second discussant. David Kershaw. Yeah, okay, I'll see you.
Great. Okay. Well, thanks, Simone. And as we just saying, thank you, Simon. Thank you, Casimiro, for organising this fabulous conference and for letting me comment on this really interesting paper. I really enjoyed reading it. It's a fabulous empirical paper. Some of my comments overlap with Kobi's comments, which I also thought were fabulous. But I'm just focusing one component part of that really on some of the potential incentive problems, I think, for the conclusions. So there's some overlap there, but I think there's enough here to actually give you my comments. They're slightly different. So the story is clear now. The story is clear from Douglas, from Kobi. There's a story here about how venture capital firms have incentive to generate high quality information. They have incentives for two reasons. One, so they can ensure the success of their portfolio companies, so they can monitor, they can discipline, they can act when things go wrong. And they also have very strong reputational drivers, reputational funding drivers for generating high quality information. Any indication that they fail to do so in their portfolio firms is for them also a signal of their incompetence, which would lead to future funding difficulties for these VC firms. So the expectations of VC-backed firms, I think, are clear. We would expect very strong internal control processes. We would expect the generation of a culture of review and accountability for financial and also other IC failings. And we would expect, I think, their portfolio firms to be able to respond very swiftly to any failings. Now, the paper attempts to assess those claims, those priors, as Douglas put it, using SOX, using Section 302 of SOX, which, as has been explained, requires managers to certify several things about the financial statements, but also requires them to certify that they have informed the auditors or the audit committee of the board and the audit committee of the board about weaknesses in the internal processes. And there are two component parts of that. I think it's helpful in thinking about the incentive problems, perhaps in relation to the paper, to actually lay out what is required. So 302 requires the signing officers to disclose in relation to significant deficiencies in relation to the internal controls that affect financial data, and secondly, to identify material weaknesses in the internal controls that are broader than just financial internal controls, which is why Douglas distinguishes between the accounting and the entity potential deficiencies or material weaknesses. Now, I think it's also helpful to understand how material weakness is defined. So here's the definition from the PACOB in their Audit Standard 5. A material weakness is a deficiency or a combination of deficiencies in internal control over financial reporting, such that there is a reasonable probability that a material misstatement of the company's annual or interim financial statements will not be prevented on a timely basis. And I want to emphasize this because here, when you just look at this definition, you can see pretty clearly that there is a significant degree of interpretive flexibility here. When you identify a problem, whether that amounts to a material weakness involves a clear act of interpretation, and there's significant room to maneuver to either report or not to report in any particular instance. Now, it's clear now that Douglas has outlined, as has Kobi, what the claims are in the paper. The claim is that these material weakness disclosures are a useful proxy for assessing internal control strength. And the claim is also that in VC-backed firms, you would expect internal control quality increases the likelihood that those material weakness disclosures are actually more informative. And that's basically what the paper finds. The greater the VC backing, the fewer material weakness disclosures you have, both in relation to accounts and entity level controls. And you also find from the paper that VC backing improves the relationship between material weakness disclosures and decreasing income restatement, suggesting that they are more informative. I think, though, there is, which is connecting to some of Kobi's comments, if you like, reputational incentive fly in the ointment of the way in which the results are interpreted. So reputation of the VC firm clearly is a fundamental driver of strong internal controls and a strong driver of reporting quality. But the reputation for having companies that generate strong internal controls and good reporting quality also generates a pretty strong bias, I think, against material weakness disclosures when the IC weaknesses arise post-IPO. That is, the reputation of the VC firm surely generates, in a post-IPO context, anti-disclosure spectacles. They don't want to disclose these material weaknesses because such material weaknesses in their VC-backed firms are a signal of VC firm failure because they've not done what the market would expect and thereby negatively impact their ability to raise future funding. So when it comes to that interpretive flexibility, I think we would expect these anti-disclosure spectacles to have a bias against reporting material weaknesses that perhaps without those biases you would report. So there'll be a bias against reporting. However, that bias will be overcome when it's clear to the VC firm and to the portfolio company that that control weakness is very likely to drive a restatement. Because if it's likely to drive a restatement, then you need to make a material weakness disclosure or you expose the CEO to sanction for not making it. Moreover, it looks even worse if you have a subsequent restatement when you've not had a material weakness disclosure. So there'll be a strong bias against disclosure, but that will change when you look carefully at what's going on and you discover, actually, it looks likely that there's a high probability we might have to make a restatement, in which case you will see a material weakness disclosure. Now, this incentive mix, of course, is more problematic than I'm portraying it. There are multiple additional components of that incentive mix that I'm not going to get into. What about the relationship between managers and the VC firm? Managers, of course, have a disincentive not to report material weaknesses if it exposes them to sanction. That said, in a manager VC repeat player environment, it might be the case that the manager's incentives are more aligned with a anti-disclosure bias that the VC firms might have. And of course, for the VC firms themselves, there is a reputational risk of electing not to make a material weakness disclosure and then that being discovered subsequently. Although that said, certainly in relation to the entity disclosures, I think those risks in practice can be pretty well managed. So if this anti-disclosure bias is real, then what would we expect? Well, it's largely what the paper finds. If this bias is real, we would expect the greater the reputational investment from the VC firm, the greater the reputational costs of a post-IPO material weakness disclosure, which increases the strength of those anti-disclosure spectacles in that interpretive room for maneuver. And therefore, I think we'd expect fewer material weakness disclosures because of that bias. Moreover, and I think this is really interesting, what we would expect is a much closer correlation of when there is a material weakness disclosure and a subsequent decreasing restatement, because it's when the VC firm thinks it's likely there will be a decreasing restatement that they are much more incentivized to make a material weakness disclosure. And I think if we were to imagine a world in which this anti-disclosure reputational bias was missing, my sense is we'd expect the opposite than this closer correlation between the material weakness disclosures and the restatements. I think in a world in which the VC firm has put in a culture of having high quality internal controls, and when you identify a problem, deal with it, you would expect them to identify a problem, to deal with it, to raise it, and to address the problem before it is likely to result in a restatement. So my sense is you'd expect the opposite if this bias wasn't there. So I think you can read these findings slightly in the opposite direction. And that has, I think, two consequences. First, I think it raises the question mark as to whether material weakness disclosures in this context are something of a noisy proxy for internal control strength and disclosure quality strength. And as I say, it seems that the paper actually can be read in a way that confirms that there is anti-material weakness disclosure in a VC-backed firm. So I'll leave it there. It's a super paper. I think there's different ways in which we could interpret it, but it certainly generates a lot of room for conversation. So thank you.
Likewise. Sorry. Thank you very much for those excellent comments from both of you. I'm very much in your debt. I've written down 2 big pages of lots of things, and I would very much hope to get copies of your slides. If you could send your slides to me, I'd be greatly in your debt and hope to return the favor for taking your valuable time to make such insightful comments. And so I can talk about some of these things. Indeed, of course, every paper, even I find my published ones, are still works in progress. And so I'm not going to be able to comment on all these things. We've thought about a few of these issues going back and forth in the drafts. And so on the reputation side, so indeed, we did comment a little bit on that in the paper. And so one measure of reputation from, for example, Nahata 2008 JFE paper is to look at VC-backed IPOs in the previous 3 years as a measure of reputation. We put that in. You can find very weak results that it exacerbates the influence of VC a little bit. Debate amongst the co-authors, we decided it wasn't meaningful enough to put it in. And the last few weeks leading up to this presentation, I have been chatting largely with Monica about this. She and I work on a bunch of papers together, so we're beating this back and forth and coming up with various ideas. And one thing I suggested is that, well, we need to look at the different limited partners in these funds to see if that actually makes a difference. And that's for other projects that I'm working on. I thought that'd be relevant. And what we discovered is that those don't seem to be as important as another thing that we discovered is quite important, is that there's some of these VC-backed ones are CVCs, corporate venture capital ones. And the corporate VC-backed ones seem to matter much less than the other types of VCs. And so if we, cutting the data in a million different ways. And so we need to think about why that might be the case. And it might fit into some of the explanations from Kobi's comments about what the channel exactly is. There are some details in Kobi's comments where we don't have all of the variables. So for example, we haven't, I guess we could get this from the prospectus data, but we haven't coded the law firm quality, for example. So I'm not going to be able to say about that. We certainly have things about the length of being private, canceled IPOs and other things. So there are perhaps more data collection that we can do and more use of data that we already have in order to get a better draft. And we also know about the dual class one. I think that's a great comment. I was also thinking, maybe we could use the Gompers, I call it the Gompers index, the G index for governance or Bebchuk's index for governance. We could put that in. And then David and Kobi made a great comment about, what's really going on and what are the incentives to do this? How much does it matter? So going with the valuation impact. And so we have examined that to some degree, and we haven't put that in the current draft. And let me tell you a couple of things why that tie back into this Kronos case that I spent a fair bit of time working on. And so what these people do when they disclose something is that they're super sneaky. Like they don't just say we have a material weakness. They say we have this material weakness, and by the way, we have all these new sales and new clients, and so they know how to engineer an insignificant price impact. And so the idea of a clean event window around a material weakness disclosure is ludicrous, like at least from all of the disclosures that I've seen, especially in the Kronos case, where they're fantastic about mixing these things with other information that they disclose. So in some ways, and then when you run your standard event study, you end up getting typically insignificant results, although with the unfortunate knowledge that it's a terrible event study without clean event windows. I partly wondered after listening to David's excellent comments that, maybe we should still report it because not 100% of these are insignificant. So for example, in the Kronos case, despite their best efforts to hide this along with other sorts of great news that they released, their share price did actually tank around that disclosure. And so there are ways to, if you will, look at subsets of the data to find these negative effects. But perhaps there are some things that we could do to report the valuation impacts and get into differential incentives to report, because not all of these cases are, of course, homogeneous, and then tie that as well to the restatements. And so your comments are really great. I'm not precisely sure the best way in dealing with them. I'm going to reflect on them, and we will certainly do our best to take them into account. I've made a lot of notes, and I thank you again. And I ask you if you can email me your slides. I would do my very best to return the favor. Thank you.
Yeah, thank you so much. Thank you to everyone who was part of this session, to all the presenters and discussants and everyone contributing via the chat function. This was another great session. Thank you. I learned a lot, and I'll hand it over to Casimiro now for a few closing remarks, I guess.
Thanks, Simone. Thanks, everybody, for having been there today. It was a great day one. We look forward to having you, well, hopefully most of you, tomorrow with us as well. And that's all. So thank you once again, everybody, for having been there. And we look forward to another day of fruitful discussion tomorrow. Thank you, everybody.
Thank you.
Thank you.